America has been downgraded. A US government bond is considered as safe as gold. But America's dominant position is now under stress.
America is drowning in debt, and that's why one of the most significant credit rating agencies has taken an extraordinary step by lowering the debt rating of the United States. Essentially, this sends a signal to the world saying, hey, we believe that America is no longer as reliable of a debtor as it used to be, and that in fact, America's debt is not as secure as it used to be. Stock markets reacted to this news with massive declines. So in this video, we'll explain what this means for America, for us as investors, for the stock markets as a whole, and of course, whether other countries could be endangered in any way. But we won't stop at this information, because something happened that hadn't occurred in 12 years. One of the best investors, Seth Klarman, gave an interview in the media after 12 years.
We've been in an everything bubble.
If you're not familiar with Klarman, he's the manager of one of the largest funds in the world. He's also an individual and an investor about whom the legendary Warren Buffett said this.
I asked Warren Buffett at one point, people who could beat the market. There's probably about 5 people who could actually beat the markets over time, and you're one of the names that he listed on that.
In the interview, he not only talked about how the markets are currently in a so-called everything bubble, but what's even more interesting for us, small investors, is that he tried to educate us on how we should think about our investments and how to behave. We'll discuss that. Hello, we are InvestGuide, and welcome to another investment video. The American national debt towards creditors is no longer as secure, and that's why one of the most significant global agencies, Fitch, has lowered the United States rating from AAA to AA+. This is a quite significant step, which hasn't been taken by this agency since 1994, or the last 29 years. This decision about the American national debt surprised the stock markets, which began to decline, which might not be entirely a bad thing among us because in recent months and weeks, the stock market has grown sharply, and some stocks are already quite overvalued. So, a healthy correction might not always be harmful. Nevertheless, the White House is most opposed to this decision, which the White House literally called bizarre and unnecessary. This can certainly be expected because this downgrade of the American debt rating is, in a way, an evaluation of how reliable America is as a debtor, let's say even a report card for the current American government and, of course, the White House. It's clear that the White House will protest this, especially when this negative assessment circulates around the world. The official explanation for why this happened is that America's financial situation is worsening. The dominance of the American dollar as a global reserve currency is also diminishing. And what is most important and also most serious is that the level or ratio of American debt compared to GDP is increasing. And GDP essentially shows the economic strength of a given country. America's debt to GDP ratio is now at 112.9%, and this ratio is expected to increase in the future. How important this number actually is evident from the fact that when Warren Buffett was asked about the most important indicator that shows us how bad a country's debt situation is, he said this.
There's the ratio of debt to GDP. There are a lot of measurements of how much debt is too much and all of that, but probably I think that if I had to look at one single statistic, I would look at that ratio, just like I would look at a ratio of debt to income.
So let's take a look at how this indicator has evolved throughout American history. As you can see, even in the recent past, America's debt to GDP ratio was over 130% during the time of COVID. Now, this indicator is slightly decreasing. By the way, we're currently at the same levels as America's debt to GDP ratio during World War II. In fact, there are 2 more very interesting graphs that we should be interested in when it comes to a country's debt. Let's go to the first one, which is the cumulative debt of that specific country. Here you can see the USA again. You can see how the US is consistently accumulating more and more debt. You can also see the huge jump here during COVID, when the USA took on a massive amount of debt. The question is, how far can this go? Now, let's move on to the second graph. This one shows us whether the budget of a given country is in surplus or deficit. Simply put, it indicates whether the country is earning more than it's spending. As you can see, the USA has been consistently in deficit since the year 2000. If you look at the current deficit, it's literally at the levels it was in 2010 during the Great Recession when the US housing bubble burst. But now, the only country that has a significant problem with a deficit, i.e., being in the negative with its budget, is the USA. Of course, many other countries also have significant deficits. For example, currently, the Czech Republic has the second highest increase in debt within the European Union. You probably understand that determining how much debt America can actually handle before everything collapses is very difficult. Nevertheless, we already know, and we've discussed it in previous videos, that the situation with America's debt is not okay in the long run. The decision by the credit rating agency to lower the rating of American debt can be understood more as a warning signal, a raised finger saying, "Hey, America, if you don't make some changes in the coming years, it's quite likely that your dominance, even in competition with Asia, will decrease in the coming decades." As for the impact on other countries, like the Czech Republic, according to some economists, it could weaken the Czech crown and raise interest on the Czech government's debt, which are, of course, negative effects. The current market situation is such that the markets reacted negatively to this news, and I, too, surrendered some unrealized profit from my portfolio. However, I certainly wouldn't see this news as a trigger for a larger crisis. According to Warren Buffett, there are probably only 5 people who, according to him, can consistently beat the S&P 500 index with their stock selections for decades, and the legendary investor Seth Klarman is one of them. However, he doesn't really seek publicity.
You are somebody who shies away from publicity. I've been trying to get you to come on the show for years, so has Andrew, so we are thrilled to have you here today.
However, he recently gave a public interview to the media, after 12 years of silence, during which he was mostly reclusive and focused on investing. So, as you can imagine, it was quite significant.
First thing is we've been in an everything bubble, I think, that a lot of money has flowed into virtually everything. You've had speculation during that bubble in all kinds of things from crypto to meme stocks to SPACs.
Actually, he attributes this everything bubble to cheap money resulting from a decade of low interest rates. Conversely, these low-cost funds naturally flowed into meme stocks like GameStop or into cryptocurrencies and so-called shit coins, like Dogecoin, Rocket, and the like. Of course, this inflates everything, inflating this overall bubble. But what Seth further pointed out is that we are currently in a very peculiar economy, where nobody really knows what's going to happen. Will the stock market drop another 30% because stocks are quite overvalued today? Especially when it comes to major tech stocks? Or, on the contrary, will the stock market rise higher? Because the Fed, the US central bank, is supposed to lower interest rates. There are truly thousands upon thousands of opinions, each one different. Seth specifically says that nobody can accurately predict what will happen today. However, what intrigued me the most is when Seth actually talked about how we, ordinary mortal investors, should invest and think about our investments.
I do think there are opportunities, but people should ask themselves, what are my interests? What kind of edge might I have? If you're from a different country, maybe you have great contacts in that country. Maybe you know a lot about the business culture in that country. And so my advice would be to go where you're naturally inclined and go where you think there may be interesting opportunities. Obviously, a market that's setting all-time highs may not be the best place to focus.
If I were to summarize it, it's actually saying that we shouldn't invest in something we don't understand, and we should find our own expertise in companies that we understand the best and invest in those. For me, for example, those sectors are banks and technology companies. I truly believe in these sectors, personally, but it could be completely different for you. However, what made me reflect the most was this sequence.
The way I think about the market is not that there are growth stocks and value stocks, but rather that all stocks may hold value, but that all stocks also could potentially be overvalued. So you have to have a mechanism, a rubric for figuring out the value of different kinds of assets, different kinds of businesses, and then figure out which ones are trading particularly mispriced.
In fact, this has always been my perspective, too, because it's used for simplification. When you say a growing growth stock, everyone might think of something like Palantir. When someone thinks of a value stock, everyone might think of something like Coca-Cola. But your goal as an investor should always be to find a growing company, a growing business, a growing stock, and invest in it at a reasonable price. And of course, for this, analysts and investors most commonly use certain models. The most well-known one, which I also use, is the discounted cash flow model, which can calculate this fair price for you. The important thing, and he also emphasized this, is that opportunities in the market can always be found.
For sure, there's more money in public markets, things have become somewhat more efficient. But I also see a short-term orientation that tells me that it's possible some pricing has actually become less efficient. I think when you look at Meta, the stock's been all over the place in a reasonably short period of time, falling to under 100, then rising back up to almost 300, literally months apart. For a large, well-established company that I think everybody can analyze.
He also didn't forget to mention Meta, where it's a huge company right in front of everyone's eyes. Even this well-known company that all investors are aware of managed to generate profits of over 100% for investors this year and partially in the previous year, especially for those investors who weren't afraid and bought when it was down. And I was one of those lucky ones, of course. This also relates to what I often tell you here because everyone, to be interesting, tries to find small companies that no one knows about, present them to the world, and pretend they've found the next Amazon, in quotes. But I don't think that's a completely good strategy. I'm convinced, and my strategy is such, that I don't try to find another small company in India that would multiply my wealth by 100. I'm perfectly fine finding the big technology companies, well-known companies, and of course, buying these companies at a good price because I know that an opportunity has now emerged that I can take advantage of. And of course, I'm also talking about companies like Microsoft, Meta, Google, Apple, and so on. This strategy of buying even mainstream businesses at good prices simply suits me in the long run. I know that my capital isn't at so much risk, it's quite conservative, especially if you're investing in an index or in Apple, for example. Well, if I buy well, then I know it will generate decent profits for me in the future, which is happening now, of course. And if you also want to learn how to invest and start making money from it, or if you want to read analyses of all the major tech companies like Meta, Apple, Google, and similar, and at what prices I would buy them today, I have posts on Patreon about that. I'll be looking forward to seeing you there. Take care.